Buyers receive the shares and sellers receive the sale proceeds. The settlement is the procedure wherein the buyers procure the shares and sellers receive their monies. The rolling settlement is when all trades have to be settled at the end of the day. In other words, the buyer must pay for his purchase and the seller delivers the sold shares in one day on the share market. Indian share markets adopt the T+2 settlements, which means the transactions are completed on day 1 and the settlement of these trades must be completed within 2 working days from day 1. However, T+1 is currently being adopted in phases. Role of SEBI. SEBI refers to the Securities and Exchange Board of India. Because the bourses have inherent risks, a market regulator is required. SEBI is provided with this power and has a responsibility of developing as well as regulating the markets. The basic objective include protecting investors' interest, developing the share market, and regulating its working. Equity market and the derivative market. Both equity and derivative market are part of the overall stock market. The difference lies in the products traded. The equity market deals in shares and stocks, whereas the derivative market deals in futures and options. The F&O market is based on an underlying asset like equity shares. Fundamental and technical analysis. Fundamental analysis is about understanding the business of the company, its growth aspects, its profitability, its debt, etc. Technical analysis focuses more on charts and patterns and tries to find out past patterns to apply for the future. We will understand both of these types of analysis in the upcoming chapters. Fundamentals are used more by investors while technicals are used more by traders. Minimum investment in the share market. There is no minimum investment required as you can even buy one share of a company. So if you buy a stock with a market price of ₹100 and you just buy one share, then you will need to invest ₹100. Of course, brokerage and statutory charges will be extra. Statutory charges. Charges like GST, stamp duty, and STT are imposed by either the central or the state government. The broker does not get these payments. The broker just collects these on your behalf and deposit it to the government. Why do companies opt for listing? The first important point is ease of raising funds. Every company wants to do further business, expand, because of which they need to raise more funds. The second is the brand image improves. Third, easier to liquidate existing shares. Fourth, enforces efficiency via transparency and regulatory oversight. Fifth, liquidity increases as well as credit worthiness. Therefore, if a company goes for listing, that means it has been successful in expanding itself and maintaining the profits, which is why it is opting for listing. How are the market weights for stock indices calculated? Step 1. Calculate the total market cap of each stock in the index. A company's total free float market cap would be each share price multiplied by the total number of publicly traded shares. Step 2. Calculate total market cap of all the stocks. To calculate the total market cap of the index, the market cap of all the companies included in the index can be added. So, if it is NSE, then there will be 50 companies, and if it is BSE, then there will be 30 companies. Step 3. Calculate individual market weights. It is important to calculate the individual market weights to know how much stock of one company influences the value of the index. You can derive individual market weights simply by dividing the free float market cap of an individual stock by the total index market cap. Logically, the more the market weight, the more percentage changes in its stock price will affect the value of the index itself. Trading mechanism. The majority of trading in India is done on Bombay Stock Exchange and National Stock Exchange. Trading in both these stock exchanges is conducted through an online electronic limit order book. This means that buy and sell orders are matched through trading computers. The Indian stock market is order driven, where buyers and sellers remain anonymous, providing greater transparency to all investors. Orders are placed through brokers, most of which now provide online share trading services to retail investors. The third part in this unit is career opportunities in stock market. There are multiple jobs in the stock market that you can choose from. The first is broker. As we have already discussed, brokers are licensed professionals who buy and sell shares on behalf of investors. They act as representatives of brokerage firms and facilitate stock trading. They need to clear NISM certifications and comply with the regulations of SEBI. There are two types of brokers in the market. The first is full service brokers. They provide a mix of services to their clients such as research, advice, and handling trade transactions. The second type are discount brokers. These brokers are involved only in buying and selling orders for their clients at a reduced commission. They do not provide additional services such as investment advice. For example, Upstocks or Kite by Zerodha are example of discount brokers. Next is advisor. With expertise as an advisor, you will provide market knowledge to your clients to pick the correct stocks. To become an advisor, you need to clear the NISM Investment Advisor Certification exam and register with SEBI as an investment advisor. Portfolio management services. Portfolio managers are prepared investment strategies for their clients based on their investment goals and risk appetite. A professional manager should actively track stock market developments and monitor the performance of the portfolio. Vast market experience and qualifications such as MBA Finance, CFA or CA are usually required. Research analyst. A research analyst performs research analysis, interprets financial data, and recommends stocks to their clients. Under research analyst, there is equity research analyst who prepares long-term stock recommendation reports based on analysis of financial statements, interpretation of financial ratios, and other fundamental parameters of the company. Then there is technical analyst. They study price charts of companies and make recommendations based on technical indicators. Investment bankers. Investment bankers serve private companies that want to go public via an initial public offering by handling the listing process in line with regulatory requirements. They're involved in underwriting new equity issuance, financial advisory, and managing mergers and acquisitions. Extensive training with a minimum qualification of an MBA can help you to gain the requisite skills. There is another option which is relationship manager. They help firms improve their relationships with existing clients and acquire new clients. They are involved in presenting the product to the customers and provide services to increase customer satisfaction. They are required to be updated with the share market trends and should understand the sales performance metrics. Professional investors or traders. I think everybody is aware with this one. Investors focus on long-term investment strategies and build wealth over an extended period of time. They design a well-diversified portfolio of a foreign security in line with their investment objective and risk appetite. However, traders wish to maximize profits by entering and exiting positions over a shorter time frame. There is no minimum qualification required to become an investor or trader.